Uber just reported earnings and the stock jumped by 4%. Shares are now up 100% year to date, making it one of the best performing stocks of 2023. At the latest share price, Uber has a market cap of $105 billion. The balance sheet includes $5.2 billion of unrestricted cash, as well as $5 billion of investments, mostly in Chinese ride-hailing company Didi and Asian super app Grab. It's also got $9 billion of debt, taking the enterprise value to $104 billion. Although Uber is performing well this year, if you zoom out, you'll see the stock is only up 11% from its 2019 IPO. That shows just how overvalued the company was when it came to the public market. Looking at the fundamentals, Uber is in a much better position now than it was then. In 2019, Uber posted an operating loss of $8.6 billion. That metric turned positive in the second quarter of this year. Free cash flow in 2019 was negative $5 billion. This year, Uber should generate well past $3 billion in cash, and total revenue has increased from $13 billion in 2019 to $36 billion over the last 12 months. But after the recent rally, Uber stock is once again looking expensive. The stock trades at about 45 times free cash flow, and that free cash flow is inflated by stock-based compensation of almost $2 billion. Add that back, and Uber is in fact valued at around 300 times free cash flow. The good news is that such a multiple isn't as high as it sounds. The nature of a platform business like Uber is that revenue growth improves margins at a rapid rate because each additional dollar of revenue doesn't cost the company much to produce. As Uber cuts expenses like marketing, its profit margins will rapidly increase. The potential for fast margin improvement is why the Uber platform model has become so popular with startups over the last 10 years. We've had Uber for dog walkers, Uber for computer coders, Uber for doctors, and even Uber for ice cream. So long as Uber keeps growing revenue, the stock can carry on going higher, and Uber seems to be doing just that. Its mobility segment grew 33% in the latest quarter, and that means total revenues are up 24% from this time last year. Let's assume Uber can continue to grow top-line revenue at 15% per year for the next 5 years, then operate with a 15% EBITDA margin. That would see the company producing $11 billion of EBITDA in 5 years' time, and a 20 times multiple puts the valuation at $220 billion. Account for some dilution and the investment return might be around 14% a year. That seems obtainable. However, there is one risk to consider. Driverless cars from the likes of Google are growing fast and could start to take market share away from Uber. Waymo One is already making over 10,000 rides a week across San Francisco and Phoenix. All that said, Uber management believes driverless cars are a win-win, and a partnership was recently announced between the two companies. Overall, investing in Uber is not without risk, but right now the company is powering forward. As a result, I continue to give the stock a bullish rating, but these are my personal opinions, not financial advice, and I do own some shares in Uber. For more videos like this, visit my website 3minutebreakdowns.com. Thank you for watching.